Good morning. Pre-leasing versus spec building and what underwriters really prefer. In commercial real estate development always involves balancing risk, timing, and capital. And one of the biggest strategic decisions developers face is whether to pre-lease a building before construction or build on speculation or spec and lease the property after it's been completed. And from an investor's perspective, both approaches can work. But from an underwriter's perspective, the two strategies look very different. In understanding how lenders evaluate pre-leased versus speculative developments can dramatically improve your chances of securing financing as well as structuring a successful project. And for developers and investors in growth markets like Houston, Katy, and Fulshear, this distinction can determine whether a deal gets funded or it gets rejected. So let's talk about what is pre-leasing in commercial real estate. Well, pre-leasing occurs when a developer secures a tenant's commitment before construction is completed. And it gives the underwriter a stable hat to hang their or rack to hang their hat on. And this is common in such sectors as industrial warehouses and medical office buildings, but also retail centers and build-to-suit developments, and as well flex and industrial parks. And in many cases, lenders like to see 30 to 70% pre-leased before they release construction funds. So let's talk about why underwriters like pre-leasing. And pre-leasing significantly reduces the risk for lenders because it demonstrates that there is a verified tenant demand for the product they're building. And underwriters typically will evaluate the tenant's credit quality. So a national corporate brand's a big help, but lease term length, rental rate stability when the lease starts, and any tenant improvements that would be required. And when a property is partially or fully pre-leased, the lender can model future income with far greater certainty. So this improves key underwriting metrics, such as your debt service coverage ratio or DSCR, but also gives a better indication of what stabilized net operating income or NOI is going to look like. And it gives us a more realistic loan to value look, as well as what the potential debt yield could be. And for lenders, cash flow certainty equals lower risk. So what is spec building? Well, a speculative building or a spec building is constructed without committed tenants. And developers build based on the market's demand and what they're projecting it to be, but also expecting it to lease the property after it's been completed. So spec development is more common in, say, industrial logistics warehouses or distribution facilities or in flex industrial parks, but also in suburban office buildings, and very common with retail shell developments for small strip centers. And many large industrial developments in Texas are spec projects because the leasing velocity is often very strong. So it won't take long to find your tenants. So why spec projects are riskier for lenders? Well, from an underwriting standpoint, speculative construction introduces several unknown variables. First being your lease up timing, how long it's going to take you to fill the building up with tenants. Also potential rate uncertainty for the rental rates, but tenant credit quality and the market absorption risk, and as well the carrying cost during the vacancy. And without committed tenants, lenders must rely heavily on market assumptions rather than contractual income that's already been agreed to. And because of this, spec projects often require a higher developer equity requirement, but also come with lower loan to cost ratios, and they look stronger at the sponsor's balance sheets. And we like to see a proven development track record for spec projects, but it also helps to have detailed market feasibility studies. So let's talk about some typical lending requirements for spec construction. And most lenders will still finance spec projects, but underwriting becomes stricter and they're more picky about the sponsors. And some of the common requirements and how you fix that is you have a higher equity contribution. And spec projects may require, say, 30 to 40% equity instead of, say, 20 to 25. But they also look for proven development experience. So lenders prefer developers with a track record of successful lease ups. Three, we look for strong market fundamentals. So underwriters will analyze population growth in the area, but also potential job growth and what's bringing new employees, but also absorption rates, as well as vacancy trends for the market and the supply pipeline of what else is being built. In markets like Houston's industrial corridors along I-10 and the Grand Parkway have strong fundamentals that often support spec development. So let's talk about why developers still build spec buildings. And despite higher financing risks, spec development offers major advantages. First being is you get faster market entry. First one there gets the initial business. And developers can capture tenant demand immediately when the market starts heating up by having a building that's already constructed. But also there's higher for potential returns or potential higher returns. And spec projects may achieve higher rents if market conditions improve during the construction period. But this gives flexibility to the tenants as well. And spec building allows landlords to accommodate multiple tenant types, which can accelerate leasing once the project is fully delivered. And this strategy is common in rapidly growing markets like Katy and Fulshear, where population growth and business expansion are driving new demand for commercial space. So what do underwriters really care about? Well, regardless of the strategy, lenders evaluate the same core risk factors. And it all comes down to sponsor strength. In particular, looking at the experience with development, but the liquidity and the net worth of the developer in question. Also, the market's demand. Are we overbuilding this particular product type? But also local economic growth and absorption trends, and how you plan to exit the loan. So how the developer plans to stabilize or refinance the property is a pretty important topic. But also looking at the construction budgets and make sure there's enough contingency built in. And lenders want to see realistic costs and reserves to accommodate the making the loan. And ultimately, underwriting comes down to risk management for the bank. And pre-leasing reduces your uncertainty, whereas spec development requires confidence in the markets. So the smart strategy for developers. Successful developers often combine both strategies. So for example, pre-leasing an anchor tenant is pretty common, but building additional spec suites to be leased after completion, which will deliver flexible tenant space with the varied needs. And this hybrid approach gives lenders income stability while also preserving some upside potential for the developer. You meet in the middle. And it's a common strategy in industrial parks, medical office developments, and mixed-use retail centers across the Houston region. So some final thoughts for the day. And in commercial real estate development, financing structure often determines whether a project moves forward. And pre-leasing can dramatically improve loan approval odds by providing verified income streams to the lender funding the loan. So spec development, on the other hand, can generate higher returns for the developer, but it also requires stronger sponsors, but also deeper market confidence. And for developers, investors, and business owners considering construction in Houston, Katy, or Fulshear, understanding how lenders evaluate risk is essential. Because in commercial real estate financing, the question isn't just will the project work, it's more of will the underwriter believe it will work and can we prove it to them? And that, my friends, is it for the day. Please visit my website, HoustonRealEstateBrokerage.com, to figure out how to get a hold of me. Love to talk to you more about your situation. Take care.